Welcome everyone to Vested Interests. This is Shane. I hope you're having a great day. In today's video, we will cover a quick review of the book I just finished, The Little Book That Still Beats the Market. With the recent pullback in the market, in my opinion, it's a great time to pick up stocks on sale, decrease that cost basis, increase that dividend yield, and future returns. My best advice in good times or bad is to have a diversified portfolio investing in good growing companies that pay dividends with positive cash flow to cover that dividend. Companies with high earnings yield, a high rate of return on capital, and pick them up as cheap as possible. That's the focus of this channel and my investing strategy. Dollar cost averaging into the stocks in my portfolio or adding from my watch list every pay period at a minimum. Don't chase hype stocks and look to get rich quick overnight. Some people might call that a YOLO, you only live once type of investing. This is not that type of investing. This is a long-term investment strategy to invest in any market or economic conditions. Long-term investing, not a day trader, not speculating. I have nothing to sell you, no Patreon, no courses, and you can see everything I'm looking at on my watch list, what I'm buying or selling, and how my dividend portfolio is doing on this channel in the weekly updates I put out. If this is something that interests you, consider subscribing to the channel and follow along on the journey to financial freedom with me. Let's build that passive income stream. I've included some links in the description below. If you want to use these links to help out the channel, that's great. If not, no big deal either. There's a Webull Link if you're looking for a mobile app for investing, and it will give you and me some free stocks based on Webull's most recent promotion. And if you're interested in purchasing any of the books that I cover, including this one, there'll be links down below to Amazon for the books I've covered, and I'll be adding to those lists over time. You can use any of these links. Amazon will pay me a small fee, and that is basically how I will monetize the channel, so to speak. And with that out of the way, let's get to the video. Now, this is obviously a book about investing. That's the whole purpose of this channel. And some of the topics covered include what to look for when investing. So I pulled some of the highlights I thought were most important and aligned with my investing strategy. First, remember, you're buying a business, not just a ticker symbol or a lotto ticket. With that said, it's important to treat it like a business and understand the product, the business sales, its profitability, debt, and free cash flow. In the case of dividend paying companies, it's also important to understand the payout ratio. That's how much free cash flow is going towards paying the dividend. You want to make sure that they can cover the dividend and it's not in jeopardy of being cut. Unless it's a REIT that must pay out higher rates of their profits, usually around 90% towards the dividend by law, you should look for companies not exceeding 80% and really should be lower than that. Even 80% is pretty high of free cash flow. So the lower the better. I typically look for companies, under 70% payout rate of their free cash flow going towards the dividends. And the reason you want the lower the better is because the lower the dividend payout ratio is now, the more likelihood they will increase that payout in the future. Next from the book, you need to understand the value of the business and future cash flow so you can estimate the current value and ultimately the stock price and what you should pay for the stock. The book does a good job of covering that process. There's also some good channels out there that cover that process as well. So if you don't know how to do a discounted cash flow, you might Google or look up on YouTube some videos that cover discounted cash flow modeling, or there's even some channels that will sell you, I think I've mentioned them before, Fast Graphs is one. They'll sell you a model that kind of gives you an idea of what the fair value would be, or a range of the fair value would be. Another one, Everything Money, is one you could check out if you're interested in paying for a service that'll do the discounted cash flow model for you. But there are some good. I've put together one actually from watching a couple YouTube channels on an Excel spreadsheet. So you can learn how to do that if you just look it up and kind of follow the process and pick the one that makes the most sense to you. There's a few different ways to do it. So more research on that is definitely advisable if you don't understand the process. Now next, similar to my criteria, the author of the book also looks for two very important criteria in companies, with a focus on businesses with high earnings yield and a high return on capital being invested. whether that's through business growth, building new factories, investing in technology like automation to decrease production costs, or acquisitions in other companies. You want the company to be investing its capital back into the business and the return on that capital to be high. You don't want a company to be investing money back into itself and getting a negative return or a real low rate of return. Uh, and then acquisitions are another way companies do that, where they'll buy out a competitor, so it increases their market share, decreases their competition, or they buy out another business arm, so it gives them more products to sell. Another way they could do it is through advertising and moving into other markets, foreign markets, for example. So you want to look for companies that fit those criterias, and the book does talk about that as well. So that's one of the things I did like about the book. It does fit, that portion of it fits my model, a focus on businesses with high earnings yield and earn a high rate of return on capital. Next, it may sound simple, but a premium should be put on buying stocks in above average companies at or below fair market value. So looking at brands you know that have been around and survived through market downturns, recessions, even depressions in some cases, may be a good place to start. Just because a company is the hot new thing doesn't necessarily make it a good company. Understand the difference between a trend and something with long-term staying power. The good company aspect goes back to understanding the company's value. Is it just the new hot trend, but in massive debt, not yet profitable? Well, that could be a problem if the market does turn, or a recession hits, or interest rates increase, which looks like interest rates are going to be increasing here. Or the one people seem to forget is the next hot trend is just around the corner. So the current hot market or hot trend doesn't necessarily have staying power, just because it's the new cool thing. And it's often those companies that are unprofitable that go out of business, and your investment in them could potentially go to zero during those increasing interest rates, market recessions, or depressions. So I think I covered it, or I know I covered it in one of my first videos when I first started investing and building out the portfolio. I really just looked at brands that I buy that are, been around my entire life. Kraft Heinz, for example, General Mills. Some people like Campbell Soup. It's not in my portfolio, but it's been around for decades. Verizon. These are the big brand names that that you use, probably aren't going anywhere, have been around for decades upon decades. 3M is in my portfolio. That one's older than I am. It's been through several recessions, if not the Great Depression back in the 20s. So these are companies that have proven over time that they can survive those downturns, and not only survive them, but also thrive through them. And some companies actually have power. Procter and Gamble is one that has what they call pricing power. So they're able to increase their cost of their products to match inflation, for example. So we're seeing higher inflation right now. So you go to the grocery store and your costs are rising. Well, that's because those companies know you need those products, and they can increase the price, and you're still going to pay for them because you need them. And last one I looked at in the strategy laid out by the book, if you have a high degree of certainty in your ability to value a business, you can pick 5 to 7 stocks every couple months or so and build out a portfolio of 20 to 30 stocks over the course of a year. That's the strategy laid out in the book. That's not necessarily my strategy, but that's the strategy laid out in the book. Focuses on holding those stocks for just over the time period to avoid paying short-term capital gains tax. So that's just over a year, and then selling those at a profit and repeating the process. That differs from my strategy of buy and hold for the long term. I buy and hold for years, if not decades, and even forever if the company remains profitable and a good company. Next up, the book offers what it calls the magic formula, right? And I know that was one that kind of got me whenever you start talking about magic formulas. A lot of times it might turn somebody off, but this is actually kind of a neat little trick. It does offer, as you can see here, the magic formula that he looks at. Basically 2 criteria: a return on capital, which is EBIT, divided by, actually it's net working capital plus fixed net assets, and it's divided by EBIT. And EBIT is earnings before interest and taxes. And then his second criteria that he looks for companies is earnings yield, which is EBIT, earnings before interest and taxes, divided by the enterprise value. And he covers how to get the enterprise value in the book. You'll have to read it to get that information. And then he looks for companies that fit that criteria. And like I said, one of the neat things in the book is he actually offers this website, magicformulainvesting.com, where you can go to that website and you can actually utilize that his stock analyzer tool, and it'll spit out 30 to 50 companies with a market capitalization over 50 million. So you enter in the criteria, and then it'll spit them out. So I've checked it out. At a minimum, it gives you 30 to 50 stocks to start with based on the market cap you select. You'll still need to figure out the value of the company and estimated stock price you're comfortable paying. I found quite a few of the stocks in my portfolio, and whenever I utilized the analyzer tool, and I was plugging in different market caps, kind of playing around with it. So it was a good back check for me, and it also gave me some additional ideas to add to my watch list. It doesn't just cover dividend stocks either. So if you're looking for growth stocks to research, it would have those in the analyzer tool as well. Overall, I found it a good book with an interesting approach and a relatively easy read. The free analyzer tool was a great bonus. It's worth a read if you haven't done so already. And folks, that's it. That wraps up this video for today. I appreciate you taking the time to stop by. Let me know what you think about the video down in the comments below. Have you read the book? Any suggestions on books I should read in the future? Let me know in the comment section down below. If you found any value in the content, if you could hit that thumbs up, or if you didn't like the content, thumbs down button. Hit the notification bell so you're updated when I post any new content, and hit that subscribe button. It helps me out and doesn't cost you a thing, and it only takes 1 second. Thank you very much if you did that. I appreciate it. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. We'll see you next time. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you are not comfortable losing. Always do your own research and invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor. See you in the next one, guys. Appreciate you stopping by.